What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over Tesla's chart and we're going to talk about why we expect the stock to fall another 50% in the year ahead. Now, of course, if you are a Tesla investor, there's no need to remind you that the stock is down 70% this year to date, and we are expecting the pain to continue going into next year. So first things first, let's talk about valuation. If you are ever trying to buy a company for the long term, and if you are looking to invest for the decades ahead, you always want to look at valuation. If you don't know how to read a chart, it's completely fine. You don't need to know how to read a chart. Let me show you how you can look at valuation and you can save yourself a lot of trouble and headaches in the future. If you're looking to buy into a company long term, you need to look at their financials and you need to look at their price to earnings ratio. If their price to earnings ratio is anywhere above 15 to 25, the stock is currently overvalued. Now, what you want to do is you always want to compare this stock to another stock in its sector. So if you're comparing Apple, you would want to compare it to Microsoft. Tesla is one of those companies that you can compare it to the tech sector or the vehicle sector, or maybe a little bit of both. Most tech companies will trade at a healthy of around 15 to 25 when it comes to price to earnings ratio, but some will trade higher, some will trade lower depending on the time in the market. Now, before we talk about the price target that Tesla is coming down to next and where you should think about buying the stock, we have to talk about its fundamentals one more time. And this is a time in which we can prove that fundamentals and technical analysis almost always go hand in hand, and you should never look at one without checking the other. So, we've already talked about the technical analysis part, which is the chart, which we are going to go back to show you the price target. Now, let's talk about the technicals one more time. The price to earnings ratio for Tesla is currently at 33, and we did mention that a healthy price to earnings ratio is anywhere between 15 and 25. During market bubble corrections, markets have a way of making fear really last, and so we are expecting Tesla's price to earnings ratio to drop by another 50% to anywhere between 15 and 17. So if we drop another 50% on Tesla, it will lose half of its market cap, which means half of its stock will continue coming down, moving it to the next price target of around $60. Now I'm going to show you something that's happening on Tesla's chart. Whenever a stock breaks out of a resistance point, that resistance point will automatically become a support. We can see an example of this when the stock broke above 175 here and it came back down to it and it came back to it again and it continued moving up. Now, that breakout came from about a 4-month consolidation that took place in 2020. The stock broke out of this consolidation area and continued consolidating between August and November of 2020 before continuing to rally and nearly quadrupling on that rally. Since then, the stock has given up all these buyers, so when the stock was trading above 175, it was trading well and it continued to hold its buyers up until 3 weeks ago. The stock broke below 175 and selling pressure has amounted much stronger, and that's because the stock is starting to dip to very old buyers who are holding the stock all the way from 2020. Now, as buyers are continuing to sell their existing positions, panic selling is happening, which is why volume is increasing and we can see the stock is moving lower. So looking back at the stock's supports, we can see that this breakout between this day and this retest here was right around 116 to 120, which the stock has now lost that support. So if you are looking at the stock's future and it's below that support, now we can expect these buyers from this dates here to begin giving up their positions. There is a gap on Tesla that's unfilled between this week and this week, and when stocks have unfilled gaps, they always find a way to refill them. I'm going to show you an example here on Neo's chart that just filled in a gap that people didn't think it would fill, but lo and behold, we can see the stock finally filled that gap, and now it's consolidating right around it. So Tesla's chart is looking to fill that gap, so we can expect it to at least move to 80 in 2023, and the next stop for it would be right around 60 to $70, which is this untested breakout here. So you see how Tesla broke here and it came back to retest and it continued moving, came back to retest, continued moving. Tesla never really retested this breakout, which means at one point the buyers are going to want to see that Tesla can prove itself at that level in order for them to trust it, which happens to be about 50% from where the stock is and also 50% from where their healthy price to earnings ratio should be. Last but not least, we're going to take a look at one chart and we're going to compare it to Tesla's. And this may be a little grim, so I hope this is not the case for Tesla, but it very much can be because PayPal is a massive company with a ton of users, and it suffered this fate. When PayPal broke below its 10-day and 50-day moving average back in 2021, we can see the stock never made it back above the 10 and 20-day moving averages, and even when it did, it continued moving down and getting crushed. So we're looking at Tesla here, and we can see that Tesla is now below all of its moving averages. Selling pressure is continuing to grow, and the stock is trading below all of its healthy moving averages, just like PayPal. And mind you, both of these companies were started by the same CEO. So that's going to be our take on Tesla. Of course, we're going to be posting more videos in the coming months and the years. That way we can update you on the stock. Please don't forget to subscribe, and thank you for the thumbs up.